Hey everybody, Boris. Welcome to our weekly technicals for July 11th to 15th. Very interesting week that just passed us by. Very strong NFP numbers, of course, out of the US, which capped the week, although it did not have a super positive impact on the dollar. And I think the fascinating part about that, and the most interesting aspect of really what happened at the end of last week, was the fact that dollar yen, despite the fact that we had really strong NFPs, actually went down, and we tested the 100-point level. And all of it, I think, has to do with the unspoken variable in the FX market, which is yield. And yield, of course, has been non-existent anywhere and everywhere you look in the industrialized world, with the exception, of course, of Australia. And that's going to get to my bigger thematic concept when we look at the COM dollars. But when you look at the U.S. yield, we've actually been going down. As a matter of fact, we went all the way down to 132 on the 10-year, 132 basis points, 1.32%. And when you're looking at the price action of dollar yen, what's really happening is that despite the fact that U.S. data is actually surprising to the upside, we're more or less muddling on through the second quarter, certainly doing much better than the rest of the world. The fixed income markets in the U.S. are not responding positively. They're actually responding negatively, or from a perspective of yield, not from a perspective of price. Obviously, bonds keep going up in price because yield is getting smaller. Now, there's two very interesting themes and ideas about that I heard this week. One of them is, of course, the more obvious conclusion that the world bond markets are basically pricing in a global recession. And while there is a lot of evidence, and certainly the Brexit situation has not helped anything, as far as global economy goes, there is, I think, still very tenuous evidence out there that the global economy is actually tipping into a recession. Europe is certainly slowing down. China is slowing down, but not to an extraordinary extent yet, and not to a situation where I think it's warning a yellow light. And of course, the U.S., which is a massive part of the global economy, is actually not slowing down, and we've rebounded substantially. So the question then is, if global capital markets or global bond markets are not pricing in a recession, then why are yields going down? And the second alternative theory kind of makes a lot of sense to me, and it's basically a story of inventory shortage. Basically, in a world where everybody is looking for safety and harbor for a large part of their portfolio, there is no yield anywhere. You look at the German bonds. I think we went all the way out to negative tenor, almost on a 10-year basis. The Japanese bonds went to a negative yield on a 20-year tenor, which is just absolutely unbelievable. Meaning that 20 years forward, you're getting negative yields every single year. So this is possibly, or most definitely, it really doesn't matter how you interpret this. It's certainly a function of massive amount of capital infusion from the central banks. And all of this huge amount of liquidity chasing whatever meager yield there is actually creating an inventory shortage and therefore pushing yields down. And when you look at currency movements, you have to always understand that the primary currency movement is always going to be driven by yield considerations. And the fact that U.S. yields continue going down is what's driving dollar yen to the downside despite positive U.S. data. Because certainly the other aspect of the story is that there's very little chance the Fed, despite relatively decent uptick in U.S. economic activity, is going to consider this strong enough scenario to warrant a possible rate hike. Certainly not anywhere within the next several months, and most likely the market at this point doesn't even have priced in until the end of the year. Remember, we are going into the broad general election starting September. The sort of unofficial kickoff date is the U.S. Labor Day, which is the first weekend in September. And although the Fed claims and continues to basically argue that they're a non-political organization, they don't really look at political considerations, I, in the heart of hearts, would be absolutely shocked if they did any kind of a monetary policy decision in the midst of one of the probably the most contested and the most viciously battled and the most politically partisan presidential elections this country has seen in more than a century. So that really puts the Fed on hold, which means that none of the U.S. economic data really matters that much. It really becomes a question of yield, yield, yield. And yield at this point is just not giving the dollar the kind of a boost it needs. So you're getting this downdraft in dollar yen, but you're also, remember, having yield compression in Europe as well. Now, we don't have any major European announcement next week. We don't have the European Central Bank meeting. We don't have, let me just make sure, I just want to make sure before I speak. No, we don't have the ECB meeting next week. So therefore, it's unlikely that we're going to get any type of major movement on the European side. But the fact that European rates are also continuing to compress keeps the euro hobbled as well against the dollar. And cable, of course, is its own disastrous story. We'll get to cable in just a second. But let's just take a look at the the key levels this week that materialized that I think really need to watch very, very carefully into the coming week. So the euro still, despite all of this turmoil back and forth, it's really been, as they say in the American South, lots of heat, little light, meaning a lot of action but very little result. It's still been a 110, 112 trade. It's just been a 112, 110 range, and it continues to be within those areas. The 110 zone, a very, very interesting look. We got to look at that on charts very carefully because that is a key support level, and it's been tested a couple of times. There've been a lot of buyers underneath it, but I have a feeling it could be ready to crack. With the yen, the story is parity. Parity got breached on Friday despite strong NFPs, and of course now the question is just how brazen the market wants to be. Because if the market wants to break parity, it almost inevitably forces the Japanese policymakers to come in and do something. They've already been on the wires talking about the idea that they don't like to see FX rates too volatile. And the sort of the rhetoric that comes out of the Japanese policy officials, the camouflage that they've been offering is that it's not that we really care where the exchange rate is, but it's just that if exchange rate stays there for a long time, that we're not going to tolerate it. And it's a way to kind of do what's called a brushback pitch to the market, meaning that we're warning you, don't press your luck, don't try to push this below 100 and keep it there for a long time. It's okay for you to test it and probe it. We probably won't intervene. But if you decide to press the dollar yen below 100 and keep it there for more than a couple of days, we're going to come in and just rip your face off and take the pair all the way up. Which is why, to me, it's very dangerous to chase the downside on dollar yen at this point, simply because of the intervention risk. But as far as the actual structural technical change goes, there's no doubt that it's a downdraft in the dollar yen. And cable, of course, is its own little glorious mess as the Brexit saga continues. We have now the battle of the two ladies for the Tory leadership. It seems to be almost as ugly as the battle in the U.S. In the meantime, we had testimony from Mark Carney last week that basically said, hey, don't look at me. You're on your own. Meaning that I'm not going to be here to support the pound. All I'm going to do is just try to provide as much liquidity as possible. This week, of course, we have the Bank of England meeting, and it'll be fascinating to see. I mean, in some ways, I think the market is almost expecting them to cut rates, although I don't think it's the necessary move for them at this point. But they are probably going to announce some series of liquidity measures, or at least pre-announce some series of liquidity measures that they may be willing to take in the near future. Cable continues to be very much under pressure, and I think if the Bank of England decides to kind of rub salt into the wound and confirm they're going to just liquefy as much as possible, we have a chance here to break the recent lows of the 128s. 128, 133 is the support levels in cable. There was very, very sloppy trade in Asia a couple of days ago when we actually breached that 128 level. We've bounced back since then, but the 130 has been a very tough resist at this point. It's basically, cable has certainly been a sell the rally trade. There's been nothing to want to turn it around. The market really needs to see, I think, some sort of political resolution, and the market is expecting, as a matter of fact, I'm looking at the expectation. The market is expecting a 25 basis point cut out of the BOE. So, I mean, the only thing that I think that could pop cable up is if they don't get a 25 basis point cut, or if they get a 25 basis point cut and sort of a more neutral commentary out of the BOE, which I don't expect. But whatever happens, cable is certainly under pressure. It's certainly going to be very likely going to be sold in front of this event, and possibly the low is going to get breached. So let's take a look at the charts here and see how everything stands, because the chart's fascinating. So back to the euro. The euro here, to me, this 110, really, really important point of point of contact, the breaking point. We've been every time we've been down to this road, they've been buyers, and they've been buyers that have been really sort of aggressive. You know, a couple of days ago they bought it very hard. They brought it back up above 111. We dipped again right into the NFPs. They bought it, but not as much. It'll be very interesting for me to see how the 110 trades, because I think if the 110 is broken with a modicum of conviction, there's a very reasonable chance that we're now going to test the 109 support. That's the post-Brexit or the Brexit peak panic support. And it's quite likely that we're going to be likely to test that. And then after that, of course, the support, really very, very hardcore support at 108s. So if you're picking bottoms, you probably don't want to get in front of this thing until it gets close to 109. You certainly I would feel very comfortable getting in front of this thing at 108s because the support here is relatively significant. As far as Euro goes on the trades, the only thing that would turn this thing relatively bullish is if we actually took out the 111s and held it on a closing basis. Then you could just maybe take a nibble to the long side and believe that we could possibly, that we would have set the near-term lows, that we have a series of higher lows at that point, and the structure looks much more favorable technically towards a run to the 112s and a much more constructive trade for the long side in the euro. Although the 112 still very much, if you look at this, former support becomes current resistance, still going to be very much a very, very big cap on the euro. There's nothing significant to make people want to buy euros at this point, especially because, as I said, on the yield considerations, yes, the U.S. yields are going down, but so are the European yields, and that's really the key to why the euros just can't get up off the ground. Now, dollar yen, a very different story. The dollar against the yen continues to be very weak. We probed the parity rate, as I said, last Friday at the NFPs, despite good news. Now, one of the most important aspects of trading is when fundamentals tell you one thing and technicals tell you the other thing. You really want to pay attention to technicals. We had a massive divergence, positive news, negative price action. Want to pay attention to that price action. It tells me that we probably revisit the 100 level. So I like selling yens here. I like selling yen here to the 100. If you're brave enough to kind of maybe hold it to 99, great, but beware that once we get below this level for a day or two, the risk of intervention is massive and the squeeze could be huge. As far as the upside goes, whatever rally we can squeeze out here, it really cannot be sustained until and unless the U.S. yields become sustainably, goes into a sustainable rally, and that's relatively unlikely at this point. The only thing we have on the U.S. data this week is the retail sales at the end of the week, and unless they are super great, which is highly unlikely, they're just simply going to be, I think, modestly better. It's unlikely they're going to re-rate the U.S. Yields to any kind of an extent. So basically, dollar yen popping up, 103 still remains the very big resist level. To the downside, it still looks very much like it wants to touch back and break the 100 significantly, and maybe even test the 99s, which is the Brexit panic low. Let's call all of these things the Brexit panic lows. At that point, your guess is as good as mine. If the BOJ decides that's it, basta, they're going to intervene, you are very vulnerable to a big short squeeze. Now, having said this, though, this is interesting. Suppose we do have a BOJ intervention. Almost every time we have a BOJ intervention, it fizzles out. So one of the more interesting tactical opportunities is, okay, you can trade it to the short side. If you do get BOJ intervention, wait until, of course, maybe 24 hours or even 12 hours into the move, and the move kind of exhausts itself at the 103s, and then you can just back up the truck and try to sell it again, because it's very likely it's going to come back at very minimum and retest the lows. BOJ interventions generally have not been able to sustain their moves to the downside, to the upside. And lastly, let's take a look at the pound and the majors here. And you see that the pound is kind of basing, I guess. This was the very sloppy below 20. We essentially went 200 points in Asia session liquidity moves, kind of probed the never depths of cable destruction here. But we do have a lot of cable news this week, and a lot of it could be very negative, and it's very possible that we could drive ourselves down back to a test of the 128s. When you look at the technical structure of cable here, it's basically shock, small consolidation, move lower. Now, generally, when you have these kind of technical formations and you have shock, consolidation, move lower, consolidation, the third move lower, the leg lower here, could be the one that finds a modicum of support. So Where could we go here? Of course, 125 would be the most natural level. That could be the peak selling level in cable for the time being. But trying to buy this to the long side, I think, is a very nasty little proposition. Unless you just take a punt with an incredibly tight stop and hope that it works. A 130 is the near-term resistance. If we clear that, then we get into a very choppy 133 resistance, and that's probably where cable is going to find a lot of resistance. There is small potential here, cable being cable, small potential here of a serious short squeeze, but you need tremendous amount of, I think, market sentiment change, something changing radically in the market. UK economy not doing nearly as badly as everybody thinks. Tories coming around, Theresa May maybe in a very fast fashion. UK getting proceeding with its movement as is. Although, as I said, if UK is hell bent on invoking Article 50, I see 120 on cable as an eventual move. You may get just sort of a relief rally that finally decided to pull the trigger, but ultimately, fundamentally, this is an incredibly negative move for cable, and it's probably going to get punished further as we go around. Cable is always going to be a sell the rallies trade for a long time for now, but in the short time this week, I think the absolute key level is if we break these 28s on pre-BOE positioning, we could very easily move all the way down to 27, 26s. And if BOE comes in and just piles on and offers tremendous amount of liquidity along with a cut in the rates, 125 certainly is very possible. Bottom line is the selling in cable is not over. The panic hasn't really reached its full fever pitch, and it remains to be a sell the rallies or just sell outright trade as we go into this week.